we're at about 30% gold, even in a conservative global account. And frankly, that's because not only is gold a good counterweight to other assets, but in and of itself, it strikes me that it is the best risk-reward asset out there for the next year or two.
Greetings and welcome to our Wealthion show. My name's Trey Reik of Bristol Gold Group, and today we're here with Adrian Day, CEO and chairman of Adrian Day Asset Management, a boutique investment advisor that was launched back in 1991 and currently hails from San Juan, Puerto Rico. And I've known Adrian for about a quarter century, and I can attest to the fact that throughout that period, his firm has remained somewhat unique in the money management industry insofar as gold and precious metals have always been a central focus of the firm, and they're not afraid to admit it. Anyway, Adrian, thanks for spending some time with us today. How are you?
Well, I'm fine. Thank you, Trey, and thank you for having me.
Mm-hmm. Terrific. So I'm on Cape Cod, and this weekend we had the high 30s and rain for all 48 hours. How's the weather down there in Puerto Rico?
Well, we're in the mid 80s with a nice blue sky and a nice gentle breeze.
Mm-hmm. So one of my first questions, since I frankly didn't know that you had moved down there, your firm offers an array of gold-focused, resource-focused, and general investment strategies. Can you just give us a little history on each of the strategies and how you decided to end up down in Puerto Rico?
Yeah, very briefly. The firm, as you may know, but just the firm, we offer individual accounts in global markets. Frankly, we're not specifically just gold or resources. So most of our accounts are global accounts. But we do offer gold and resource special accounts. But I would say most of our accounts are people who come to us because they're conservative, they're low risk, they want exposure to the global markets, but they also like gold. And so they come to us for that. We also manage, I should say, Peter Schiff's Euro-Pacific Gold Fund. And we've been doing that since 2013. So our accounts have always included some gold, because I think gold has many benefits, many attractions. It serves many purposes, fulfills many purposes. One of them is to act as a counterweight to the rest of a portfolio. And so we've always had some gold in portfolios. Right now, I have to say, and we can get into this obviously, but right now, we have very, very high exposure to gold in even our conservative global accounts. We're at about 30% gold, even in a conservative global account. And frankly, that's because not only is gold a good counterweight to other assets, but in and of itself, it strikes me that it is the best risk-reward asset out there for the next year or two. So we're very high. Quickly on Puerto Rico, when Peter Schiff asked me to manage his gold fund, he's already in Puerto Rico. He asked if I would mind moving to Puerto Rico, give it a try for a couple of years, see how you like it, because of the tax benefits. So I get tax benefits, but also the firm gets tax benefits from having the management in Puerto Rico. And I moved down here, I'm single, so I can move where I like, when I like. And frankly, it's, I love it down here. The people are super nice, really friendly people, just genuinely helpful people. Lots of good restaurants. I like to eat, so that's good.
Have things fully recovered from the hurricanes a few years
back?
Well,
the big Hurricane Maria, what was that, 7 years ago now, 8 years ago now, in the middle of the island and in the more rural areas, not really. It's to be honest with you, it's not been very good. I mean, the U.S. government did send a lot of aid down here, but as you probably read a lot, or may have read, a lot of that was stolen. I mean, directly stolen. More of it was diverted to, cousins who didn't know what they were doing.
Mm-hmm.
And a lot of it, frankly, was just totally wasted. It's very, very sad.
Yeah.
But I mean, in San Juan, yeah, it's completely recovered. Yeah.
So last question on the firm. Are you half gold, less than half gold? I got the impression you were more than half gold.
I think if you look at the total, I mean, everything we do, yeah, I would say we're more than half gold right now.
Okay.
Yeah.
Mm-hmm.
Yeah.
So, and then the other question that I had, I have always, gold bears have a tendency to say, why don't you start your analysis in 1980, when gold was 850, whereas gold bulls have a tendency to start in March of 2000. And depending on which of those starting points you choose, gold's 30-year history is entirely different. And I've always said that there are decades to own gold and there are decades not to own gold. And back in 1980, interest rates were very high and falling, and inflation was very high and falling, and savings were strong, and GDP and productivity were strong. So gold wasn't really a compelling investment thesis, pretty much the opposite of March of 2000. But the reason I give that introduction is you started your firm in 1991, right in the middle of that 20-year stretch where, quite frankly, gold and, it wouldn't have necessarily been on my radar screen. So what led you to make gold one of your focuses, not your only focus, but one of them in 1991? And how'd those early years go?
Yeah, no, of course, you're absolutely right. The starting point of any analysis makes a huge difference. And yeah, I mean, I think it's a little unfair to say we should start in 1980, which was right at the peak, but pick another date. As I say, I've always thought that gold acts as a foundation of a portfolio. It's insurance. It is very simplest, or it is very base. It's insurance, and it acts. It can move in contrary directions to the broad market. So I think it's always good to have some gold in a portfolio at any time. Because we never, even when the world is looking good and the iron curtains come down and the stock market's going well, something can always come out of the blue, and gold will tend to protect you against that. So in the early years, we didn't have a lot of gold, I have to say. I don't know if this violates any SEC rules or not, but in the early days, our biggest gold holding was Franco-Nevada. And that didn't serve us too badly, serve clients too badly. I think
Franco-Nevada is a royalty company, correct?
Correct, yes. And I should also say, this, but I should also mention the Franco-Nevada that we bought in 1991 subsequently merged with Newmont, and then it got spun out again. So, it's a different stock than it was back then. Mm-hmm. But yeah, so I mean, I think you're absolutely right. There are times to own gold, and there are times. I think one should always own some gold. There are times to own a little gold. There are times to own a lot of gold. Mm-hmm. But I say to people, when you're looking at the core function of gold, which is for insurance purposes, you don't look at your house and say, well, we haven't had a hurricane for a few years. I think I'll get rid of my home insurance. Mm-hmm. You always keep your home insurance. Mm-hmm. Now, there might be times to increase that, depending on your financial circumstances and so on and so forth. But you always have some insurance. And I think that's the same with gold.
So in the last of my sort of bench clearing questions to begin, when your gold focus, and forgive me for continuing to repeat that, but it's fun for me to talk to someone who recognizes the advantages of gold. But do you have a framework for what you need to see that maybe takes gold to the conclusion of your investment analysis? In other words, is gold a permanent investment, or are you still owning gold because of imbalances, et cetera, that you perceive in the global financial structure? And is there a time when we won't need gold again?
I don't think there's a time, not in my lifetime, when we won't need gold. I mean, again, if you're looking at it as insurance, even if you haven't had a fire in your home for 50 years,
Right.
it's still a good idea to have that fire insurance just in case. So I think we'll always need some gold.
Okay.
But right now, and I know we're going to get into this, I mean, right now, with the imbalances in the world, with the huge amounts of debt at the government levels around the world, particularly in the US, we absolutely need a higher exposure to gold.
And then moving more specifically into the recent past, 2024, at the beginning of the year, the Bloomberg Strategist poll was forecasting a 1.7% increase in the S&P, which was the most bearish in the 25 years of the survey. But by the end of the year, we had the S&P up 25%, and strategist predictions for 2025 are the most bullish since COVID. You follow how that progression normally works. So last year, I think it's fair to say stocks were surprisingly strong, general stock market. Yet, even with 10-year yields rising 18% and the dollar hitting sort of 2-year highs, gold was up even more at 27.2%. So this is probably the most important question of the morning. But why do you think that was? What's taking hold here?
Well, I think everybody knows the main reason. I mean, certainly, if you go back to the fall of 2022, for the first 18 months, it was of that bull market. It was primarily central banks who were buying, right? We know that. It was primarily central banks who were buying. Then, beginning in January of last year, beginning at the beginning of last year, you started to get more interest from Chinese consumers. And it was really only in the spring and summer of that year that you started to get interest globally. European ETFs started getting inflows. You had a lot more interest from the Middle East. And I think you still didn't have much interest from North America. But I think you've had different drivers, different buyers, but also people buying for different reasons than they were buying in the 2009 to 2011 or 2001 to 2008 periods. They were not being driven by economic factors, but they were being driven by other factors. So obviously central banks, we know why they were buying, to diversify their reserves in the face of dollar weaponization, which I should sort of say didn't start on January the 20th of this year. That's been going on for quite a long time.
Right, especially since the Russian freeze, correct?
Well, I would say even before that. The U.S., the U.S. has liked to exert its influence and power. That's a nice way of putting it. For many, many years. I mean, think of the way they basically told the Swiss that they had to change their whole banking system because the US didn't like what they were doing.
And this goes back to Obama with Bank Paribas, right? The French
I was going to say there's the Bank Paribas incident. There's the Santander, who made a loan to a Spanish company that wanted to build a hotel in Cuba. Perfectly legal under EU rules, perfectly legal under United Nations rules. But the US says, well, we don't like Cuba, so we're going to fine Bank Santander billions of dollars for the So it's been going on for a few years, but you're right. I mean, obviously, the confiscation of Russian assets really stepped it up. Chinese, we know they've been concerned about the economy, about the yuan, about the fragility of their own banking system. They're not allowed to buy cryptos, so there are many places that they would want to put their money for security. And wealthy individuals around the world, wealthy individuals, Middle East, Asia particularly, but also Europe and increasingly the US, are just concerned, as you said earlier, about the imbalances in the world.
Mm-hmm.
And so all of these factors are not what I call the traditional economic factors that drive gold. You know, if you think what drives gold, you want a lower dollar, you want low real interest rates. You want higher and increasing inflation. And, you know, from 2022 to 2025, we didn't really have that.
Mm-hmm.
So the environment was not the normal economic environment for gold. And so to me, it's not really a surprise that up until recently, North Americans haven't really been participating in the gold market. Right. Because the stock market's been doing well, the dollar's been strong, the economy has apparently been strong, inflation has been coming down and apparently under control. I keep saying apparently, but you know, on the surface, things look good, and the S&P was doing well. So why invest in gold would be what most people ask themselves.
So putting you on the spot a bit, do you, in terms of the U.S. deficit, which you and I have been following for 20 years, and I would have said, 20 years ago that deficits were a problem when they were 400 billion. Now we're in the $2 trillion range, and we seem to be normalizing these $2 trillion deficits, even though we're not in an emergency environment anymore. Do you get the impression that people are finally concerned about sort of a doom loop on interest costs and that type of thing?
Yeah, I think so. I think so increasingly. I mean, a lot of it is political, as you know. I mean, it's astonishing to me that suddenly the Republicans in Congress, seem to be fiscal hawks. I mean, you have to ask, where were they, not just for the last 4 years of Obama, but where were they for the 4 previous years under Trump?
Right.
When to be a fiscal hawk made you an extremist, right?
Mm-hmm.
But I also think, again, politically, Elon Musk and the Doge Commission, although the two things are connected, but they're really separate issues. You can have a lot of waste even with a balanced budget, and you can have no waste with excess debt.
Mm-hmm.
But the two really, are connected, obviously. And I think what Elon Musk, all these different things that Elon Musk has drawn attention to, the waste, have made people focus a little more on the budget and therefore on debt. Among what we'll call, investment among the investment community, yeah, I think there's much more of a focus on really the impending crisis, because it really is a crisis.
Mm-hmm.
It's been going on for 15 years now. I mean, the number of people that are buying long-term U.S. debt are going down meaningfully. No longer, obviously, the Russians aren't buying anymore, but the Chinese are selling. Even the Japanese, who are our friends, are no longer buying. That's for purely economic reasons, not for political reasons. With China and with Russia, it's political reasons. But we're not getting the sort of the big buyers of, if you go back 10 years, and who were the big buyers of U.S. bonds? Well, it was Russians, Japanese, and Chinese. They're not buying anymore.
Mm-hmm.
It was regional banks in the U.S. Well, they stopped buying very dramatically with Signature Bank and Silicon Valley and that lot. And of course, it was the Federal Reserve. So who's buying now? Our insurance companies, people with long pension funds, people with very long dated obligations, and his hedge funds who are looking for a leverage way for, benefiting from a reduction in interest rates. I don't know very many what I'll call ordinary everyday investors, whether it's, institutions or retail, who are buying 30-year bonds with the intention of holding them 30 years.
Right.
I mean, it's just not an attractive investment opportunity.
Speaking to this,
anyway, my point was that, we've seen this reduction in interest in the 30-year, and that's gone along with obviously a reduction in the amount of 30 years and 20 years that are being offered. To me, it was criminally irresponsible. And I mean that, I emphasize the word criminally. It was criminally irresponsible it was Obama years. In the Obama years, when interest rates in the US were zero, lower bound zero, not to have issued more of the debt at long term. And I don't just mean 30-year, I mean 50-year and 100-year. If Argentina, Italy, as well as Austria, if those countries could issue 100-year bonds at 6 and 7% interest rates, what would the US have had to pay on a 100-year bond?
Right.
I don't know, 3.5, 4. It was totally criminally irresponsible not to do that at that time. That opportunity has now passed. But as you know, under Yellen, I don't think economic historians will give Yellen a lot of credit for the way she managed the budget under her 4 years. It was, because she really went all the way to, as you know, to short-term bills. And at this point, and she left the Treasury empty. I mean, you remember that famous interview on the Friday before the swearing in of President Trump of the new administration. Mm-hmm. She said, basically that the Treasury is going to run out of money on Tuesday. Good luck. Mm-hmm. So currently, and I'm not making this a political thing, currently we're in a very, very serious situation. Right. And it's a matter of juggling balls, frankly, to keep the thing going.
So along these lines, over the weekend, because I'm not a bond guy, but I read over the weekend that the 10-year Treasury price declined 3.8% last week, which is the worst week since the repo crisis in 2019. The same time, the stock market was up 5.7%, the S&P, which was the best month since like November 2023. So my point is, as gold guys for a couple of decades, we've always talked about the possibility that, the dollar's, day of reckoning may actually come, and gold may start to be perceived as a preferred reserve currency. And I'll tell you, for 48 hours last week on Thursday and Friday, I thought we might be there. What do you think?
Yeah, no, I agree with that completely. I mean, the one big factor that is missing, or that has been missing from gold, is, a collapse in the dollar. And I mean, we all know why the dollar has held up so strongly over the last 10 years, 20 years. It's because of a lack of good alternatives.
Right.
What one can't help, I'm trying not to be political, but one can't help scratching one's head if the US has this funding problem, and part of a problem is that they're not getting foreigners to buy long-term US bonds. It's a puzzle why the US seems to be doing everything possible to make foreigners not want to buy our long-term bonds. I mean, there was a proposal was it over weekend or was it Friday, where Miran, who's the chairman of the White House Economic Council or the Council of Economic Advisors, came up with 5 proposals, one of which was to reintroduce the 30% withholding tax on foreigners holding treasuries. Mm-hmm. Well, that does not make me want to say, let me run out and buy some of these things.
Mm-hmm.
So anyway, that's...
So skipping a little bit across the street in Washington to the Fed, I've always avoided Fed discussions in large rooms because nothing turns U.S. investors off quicker than criticizing the Fed or the dollar. It's not a popular line, but I've always said that Fed cred or Fed credibility is really starting to be challenged. And so generally, I'm interested in your thoughts on the Fed, but specifically, since you mentioned the political thing, I will point out that in the last 72 hours, we've had three regional presidents and governors, Collins, Goolsbee, and Williams, come out dramatically from the Fed's lane of monetary analysis to openly criticize President Trump's, tariff efforts as inflationary, poor for employment, and bad for the economy. So that was a long-winded question. What do you think about Fed credibility and gold at this point?
Yeah, no, I think the Fed is definitely losing credibility. There's no question that the tariffs, the whole tariff issue and the back and forth has put a focus onto something other than the Fed.
Mm-hmm.
So if the economy slows dramatically or inflation picks up, people are going to point to tariffs. Whereas in my view, before January the 20th, before the administration came in, the economy was significantly slowing anyway. And if you look at the inflation numbers, the price numbers, because that's not inflation, that's the result of inflation. That's
right.
But if you look at the price in inflation numbers, whether it's CPI or core PCE or whatever it is, they've all been trending upwards, slowly, but trending upwards from last June. So, although we look at a 2-year graph and we say, wow, hasn't inflation come down a lot? Well, yes, it came down from a very unusual spike because of COVID. But where we are now, the last 6 months, or really more than that, the last 10 months, it's been trending up, number one. Number two, the numbers are still way above or meaningfully above where they were pre-COVID. And number three, they are, of course, well above the Fed's own arbitrary 2% target. And so I don't think the Fed should be patting itself on the back for inflation. So even if we didn't have tariffs, and I would dispute the fact that tariffs are inflationary. Mm-hmm. Tariffs are definitely bad for the economy. They definitely raise prices on certain goods for U.S. consumers. Mm-hmm. And so I've always thought it perverse for a country to want to impose tariffs on imports when it's only hurting their own consumers who want those products. But they're not inflationary. I mean, as you know, there's different views on this. I mean, I'm a monetarist.
No, I'm very interested. Why do you think what you're in a minority there? Why do you believe that tariffs are improperly billed as inflationary?
Well, because people look at price.
Right.
So if you impose tariffs on Britain or United Kingdom, the cost of my Scotch whiskey goes up and the price of my cheddar cheese, real cheddar cheese, not Wisconsin cheddar cheese, the cost of my cheddar cheese goes up, right? But if the Fed hasn't increased the money supply, if we haven't had an increase in money in the economy, then the price of something else has to go down to offset that.
Yeah.
So we're only focusing on the individual prices that go up. We can only have, or you can't have all prices in an economy moving up unless you've had an increase in the money supply.
Interesting.
And that's Milton Friedman showed us that 40 years ago, and I don't think anything's changed since then.
Mm-hmm.
So you can have individual prices going up, but you can't have all prices going up. And that, of course, goes back to a base. It goes back to the Fed. Now, there's other factors, of course. The Fed can increase the money supply, but if the banks simply borrow the money and put it back on reserve with the Fed, then you're not increasing the money in the economy. I mean, the money has to get into the economy. But if the Fed doesn't increase the money supply, it's very difficult to have inflation without the Fed increasing the money supply. So they're the ones that are ultimately responsible for inflation, and they don't seem to. Well, they certainly don't. They certainly don't acknowledge their own responsibility.
Yeah.
But I think the Fed is beginning to lose credibility. It was losing it under Yellen, and then Powell came in and had a much more. I think Powell restored some of the credibility. Certainly for the first couple of years, it's difficult to criticize what he did too harshly, certainly compared with the last 40 years of the Fed. I think he's been, a better Fed chairman. But
so if I had to criticize them, I'd take 2021 when the Fed did 120 billion of QE a month with CPI already heading to 7%, GDP at 6%, and unemployment down from 14 to 5. I mean, I do think that year will go down as certainly in the top 5 policy mistakes of all.
Absolutely. It was a panic decision. It was a panic decision that was not necessary. But I mean, really, you go back to 2008, 2009, when they increased the money supply so dramatically. And people will say, oh, we were in uncharted territory. We had no idea what was going to happen. It could have been the worst disaster. It could have, the global monetary system could have blown up. I don't think any of that was true. But even if it was true, or even if that was the fear, the big mistake under Bernanke and then under Yellen was keeping that easy money for so long.
Right.
Once we were over what was perceived as the danger zone, they should have dramatically pulled in the balance sheet.
Right.
And they just kept it going for far too long. And
so my last Chairman Powell criticism is, on top of everything, not only have they not admitted their contribution or addressed their contribution through that QE, but at Jackson Hole, he actually started making light of it. I'm sure you remember this when he said we were not alone. We were on the good ship Transitory. And when I read that quote, I almost fell out of my chair. I was like, the Fed chair is now joking about the worst inflationary outbreak in the past 50 years. I mean,
no, absolutely not something not a joke that should have been said publicly. No, absolutely. I don't mean to. I'm not a defender of the Fed. I mean, I think the Fed as an institution is flawed.
Right.
I guess I'm just trying to say that Powell perhaps is not quite as bad as Yellen and Bernanke. And frankly, Greenspan. I think Greenspan was a disaster. And why I criticize Greenspan so much is because he actually knew better.
Right. And he did the variable mortgage thing when he got the whole country to lever up on variable mortgages and then raised interest rates, at 18 consecutive meetings or whatever it was, which I've never forgiven.
And then, of course, what he did with long-term capital, the hedge fund run by the smartest people in the room. He introduced, it was really a Greenspan put for many years, right?
Right.
That turned into the Fed put. But the criticism, we're getting a little, but my criticism of Bernanke, of Greenspan, is he actually knew better.
Right.
Whereas I don't think Bernanke knew better.
Right.
And I don't think Yellen knew better. Yellen is a labor economist. I don't think she has a very broad understanding of the economy, frankly.
So before we move on to one of our favorite mutual topics, which are gold equities, my last question on the recent gold price strength is, we have this Basel III change coming in June, which we've read about for the better part of a decade, but has never sort of gotten over the finish line. And it has been suggested to me by some people I consider to be pretty sensitive to movements in the gold market, that June Basel III change may be one of the reasons gold has had this recent bout with strength. What do you think?
Yeah, I mean, I think it's like, as with a lot of markets, when you're in a bull market, everything that is marginally bullish becomes bullish and has an impact.
Mm-hmm.
If this had happened 20 years ago, or certainly in the 1980s, it wouldn't have had any impact on the price of gold. That's the way I'm looking at it.
Mm-hmm.
But when you're in a bull market, then every bullish factor
Right.
just adds to the price and adds to the bullish environment. Like Chinese insurance companies now being able to hold gold in their reserves. Mm-hmm. Basel III is another example. So all these things build on each other. The thing I would say just before we get off that and onto equities, I think the big message that I would have is that the people have been buying gold for the last 3 years, and the reasons they've been buying gold have not gone away.
Right.
If anything, they've only got more serious, but they certainly haven't gone away. Mm-hmm. And so that buying is just going to continue. And that buying also is relatively price elastic. Price inelastic. I don't think central banks who are worried, I don't think China is going to say, let's not buy gold at 3,000, and let's just hope that nothing happens for the next few months.
Right.
So I think that buying is going to continue. That is the main message.
So moving on to portfolio management, can you talk a little bit about the various roles, complementary or otherwise, that gold and gold equities can play in a portfolio?
Yeah. Obviously, if one's looking for insurance, one really stays with gold bullion or physical gold ETF, such as the one put out by your former employer.
Mm-hmm. Mm-hmm. Sprott.
Yes. Mm-hmm. PHYS.
PHYS.
So I think if you're looking for that defensive measure, for that insurance in an account, if you're looking for something that will definitely go up if the rest of the portfolio goes down, then you're sticking with gold bullion or gold bullion ETFs. If you want to maximize your returns on gold, then obviously you go to gold equities. Typically, if we're looking back in the 70s, before I had the money management firm, but when I was doing it myself, and certainly if you're looking at the 2000s and then the 2009 period, once gold has started to move, you typically move out of gold and into gold equities, because that's where the leverage is. We are holding on to our gold, I have to say. We have not sold all our gold in order to move over to equities by any chance, by any means. I think both have a very strong role in a portfolio right now. We have emphasized the seniors because the seniors tend to be the ones that move first, as you know. And not only do they move first, but they're more certain to move. So if you own, Barrick and Newmont and Agnico and Kinross, some of them will do better than others, no question. But in the last, 6 months, they've all moved up. If you buy Ajax Consolidated and, Moose Pasture Incorporated, they may or may not move up. So they're more certain to move and they're the first to move. But we're certainly got a large exposure to juniors at the moment, which haven't yet really moved. as you know, in a broad sense. I mean, individual stocks have. But as a sector, as a group, they really haven't moved yet. And that's the next thing ahead.
So gold last year was up 27% through late October. GDX, the ARCA gold mining ETF, was up 42%, I think, at the peak in like October 22nd. And GDXJ was, up a similar amount, 46%. But by the end of the year, GDX and GDXJ only closed up 10 and 15%, which was obviously a very disappointing 3 months. Why do you think the gold shares lagged so much in the fourth quarter last year?
Well, I think the fundamental is that the drivers of gold were not the typical drivers that attract North American investors and
Gotcha.
Western investors generally. The economic environment was not conducive to gold investments.
Mm-hmm.
You started to see things change in the summer, and then you got the Trump election. And with the Trump election, people thought we're going to have a strong economy, we're going to have a strong stock market, we don't need gold anymore. So, I mean, I think that was the main reason. And as you know, Trey, it's been astonishing to me that even with gold at record levels, and we'll talk about the stocks in a minute, but even with gold at record levels, the interest among general investors, both generalists, funds, and individuals, has been very, very, very modest.
Mm-hmm.
You look at the GDX, which, as you say, is the largest gold mining ETF, and there's only been 3 days this year of inflows, net inflows.
Incredible.
3 days this year of net inflows. I mean, it's just unbelievably astonishing. They've lost $2.2 billion in outflows this year.
So speaking of this year, I looked before we got on. So intraday to this morning, the S&P was down 7.3% year to date, and the GDX is up 47. By the way, did you know that it was up 47% year to date? It's a pretty big number. It surprised me. And the GDXJ is up 44.5. Of course, nobody's talking about it. Nobody's writing about it. No one knows about it. But, I mean, that's a pretty encouraging thing in terms of changing the gold stock lag, don't you think?
Oh, absolutely. No, I mean, and I think we're just beginning to see that turn in interest. I mean,
Mm-hmm.
No one can complain of what the senior gold stocks have done this year, 6 months, even a year.
Right.
I mean, it's difficult to complain, but they haven't exhibited the normal kind of leverage that we expect from gold stocks. We're just beginning to see that, I think, this year. If you look at, in fact, I'll do it while we're here. If you look at 1 year, the XAU is up 40%, gold is up 34%. So no leverage at all. If you look at 6 months, they're essentially the same. No, the XAU has actually underperformed gold for 6 months.
Wow.
Now you look at, as you say, year to date, and you're seeing that leverage begin to demonstrate itself. Still not seeing it in inflows into the GDX.
That's a good point.
But a bit of a turn. I mean, I said there were 3 days of net inflows this year that were reported by VanEck, because they don't report every day, as you know. But only 3 days of net inflows this year. 2 of those were in the last week. So, okay, 2 swallows don't make a spring, or is it a summer? Summer. But nonetheless, I think we're beginning to see that turn. But you look at the gold stocks, you have, obviously they've done well, but you look at very strong margins, as you know, and growing margins each quarter since the first quarter of last year. So 4 quarters, and then this quarter is going to be the same thing, I think. We haven't had the results yet, but so you've had 5 quarters of growing margin expansion, which means increased cash flow. It is the sector of the S&P, the sector of the New York Stock Exchange, rather, with the fastest growing growth in cash flow over the last 12 months.
Wow.
And I mean, that people don't always sort of really focus on it enough. I mean, just look at those margins. It's a bit frustrating to me, Trey, to be honest, that every single quarterly reports, quarterly financial call that I've been on for the last year, so that's 4 quarters with maybe 15 companies, every single one, they spend all half a conference call talking about how costs are going up and the cost pressures and all of the measures that we're doing, and our focus is on keeping costs down. Okay, important, very important. But when the price of gold is 3,100 and your all-in sustaining costs are 13 or 1,400, that's a pretty darn good margin. And I think we should spend a little more time talking about how the gold price is going up so much faster than the costs are going up.
Right. You bring up an interesting point for about, in the drawdown from 2012 to 2015, the gold mining industry earned a unfavorable reputation for capital discipline and execution. Do you think, because you're bringing up a good point, why haven't earnings done better? And there's a lot of, high grading, low grading when the gold price goes up. I understand all that. But do you think that the negative reputation for gold industry management is still deserved, or do you think the industry has made some improvements?
The industry has definitely made some improvements. I think arguably, I mean, what happened in the 2011-12 period was disastrous, just overpaying for marginal assets. And it wasn't just overpaying for good assets. It was overpaying for marginal assets. And I read a report, it was John Tomazos who did it, I'm pretty sure, but in the 3 years after 2012, he said over 75% of the investments were written off.
Right.
Not written down, but written off.
Right.
That is a disaster. And if you're a generalist investor who finally decided to get into gold in 2010, 2011, and you lost 86%, because you were in the big stocks and you lost 86% of your investment over the next 4 years, and then you say, why did this happen? And you look at the disastrous investments that were made over that time. Yeah, it takes a long time to get over that. And I think there's no question that's one of the reasons that people, generalists, have been so slow to get back into the space. And, the sad thing is they finally decided to get back in. Let's buy Franco-Nevada, the safest possible gold stock out there. And then, of course, they had Cobre Panama.
Right.
And they say, oh, no, you can't win in this space.
Right.
So I think it did take time. But to answer your question, no, there's no question in my mind. I think we have, on balance, we have better management now than we did 15 years ago. People definitely learned their lessons. As you know, there are a lot of CEOs that were fired in that period.
I think I can only count on one hand the amount of CEOs that are still around. Like, we know them. That's Sean Boyd, it's Mark Bristow. There's, about 5, but that's it.
Yeah, and we should all, since you mentioned those two, whatever mistakes Mark Bristow may have made, one mistake he didn't make was, and neither did Sean Boyd, those two did not join the party of overpaying for marginal assets back then.
Right.
We should emphasize that. But so, yeah, I think people have become much more disciplined. There's much more of a focus on paying down debt. I mean, the XAU is debt-free or net debt-free. Net net cash positive, maybe is a better way of putting it,
Mm-hmm.
which is astonishing for a capital-intensive industry.
Right.
Now, of course, that includes Franco and Wheaton and the big royalties, which have a lot of cash. But still, you look at the large mining companies, and the balance sheets are remarkably strong. With
Mm-hmm.
some of them, again, some of them net cash positive. In a
Right.
capital-intensive industry, that is, that's very unusual. So you look at the XAU and you compare with the S&P. The valuations are better, the price to cash flow is better, the dividend yield is higher, the balance sheet is better. It's really, you don't often get that situation, and that's despite the stock prices having done gone up 50% in the last whatever period it is.
So at your firm, when you look at gold mining companies, we all know they're cheap, and there's lots of different ways to look at ratios to gold, et cetera, over the long term. But of course, there are some reasons why those ratios should have moved out of favor. There are more shares, the mines are more difficult, grade is lower, et cetera. But when you look at a gold mining company, what are your one or two favorite financial metrics to prove to your wife or someone else how cheap gold stocks are?
Well, before you get to financial metric, the first metric I look at is management.
Okay.
Management to me is absolutely critical, even with the large companies. And, we all think that management's important when you're dealing with a $30 million exploration company. But it's also important. You mentioned Sean Boyd. I mean, just think what kind of company that man built, Agnico Eagle. So I think management is absolutely essential, and it's the first thing I always look at any company. Frankly, it's less important with Nestle and
Right.
Hong Kong Bank than it is, but it's still important, and we can see that in the gold mining space. Franco-Nevada, Wheaton would be other examples where management,
Right.
has really excelled. So that's the first thing. I think the prime financial metric that I look at is price to cash flow and price to free cash flow.
Mm-hmm.
Because there's no point in having a lot of cash flow if it's not free cash flow.
Mm-hmm.
So those are the two most important metrics to me. I mean, you can look at the price or the cost of gold in the ground, the valuation of a
The reserves. Mm-hmm.
And, that's an interesting metric, but as you say, it's very difficult to look at it's very difficult to look at a lot of the metrics and just say, oh, well, this one's much less than that, so therefore it's a better buy. That doesn't follow because, as you know, an ounce of gold in Nevada that's going to be mined in 2 or 3 years is much more valuable than an ounce of gold in Sudan
Tanzania.
that's not going to be mined for 50 years,
Right.
Or might never be mined.
It's interesting. I think that the gold mining industry goes through cycles. And back, I remember in 2001, 2002, the big variable was reserves and resources, and
Yeah.
nobody was, in fact, everybody was losing money. So there was no reason to look at cash flow because it was negative everywhere. And it does go in cycles. But I do think we're going to have a time if gold keeps rolling. Goldman Sachs put out an update on their recent report this morning, and their new tail risk target for gold at the end of 2025 is, I'm sure you saw this, $4,500, which when you think about how many people benefit from a high gold price at Goldman Sachs, the answer is very few. I'm shocked to read, those types of numbers in print. But my point is, let's just say that were to happen, I do think the pendulum would swing back to reserves and resources and less on free cash flow. Don't you think?
Probably, but to me, I've never been a big fan of the ounces in the ground sort of argument.
Okay.
All ounces are different. Obviously, you want a company with reserves. Don't get me wrong. If you're a big mining company and you're mining 5 million ounces a year, we as investors want to know that they're going to be able to continue to mine those 5 million for the foreseeable future. And where are those ounces going to come from? That's important. But if you look at the big companies, Newmont and Barrick and Goldfields, I mean, they've got decades of reserves ahead of them. So that's never been my most important metric. I mean, it's important to have the reserves, but the valuation of reserves in the ground has never been my most important metric, to be honest.
Gotcha. So last question for folks that are looking at establishing their own representation in the space. I feel obligated to bring up the issue with you of diversification, because I do think there are very few industries where owning fewer than 5 or even 10 stocks makes less sense than gold mining. So can you give us your view on, which parts of the gold industry cycle you need to be involved with? I would say all of them, and, the number of stocks that make sense.
Yeah. Well, first of all, I don't always agree with everything that Warren Buffett says, particularly when it involves taxes. I have actually written him a letter in the past saying, if you think taxes should be higher, please pay more, but don't argue for mine to go up.
Right.
But one of the things he did say, actually, was Charlie Munger, I think, who said that diversification is often an excuse for ignorance. And I do think there is a lot to be said for that. And I just want to put something on the other side of a scale in diversification, because obviously having all your eggs in one basket is a gross mistake. But the more one buys, the more one is going from high conviction companies, which one knows very well, to second or third and fourth conviction companies, which by its nature, the ordinary investor knows less well. So one thing I would say is, whatever number you buy, make sure you really know those companies. It is astonishing. And you and I deal with a lot of different kind of people. I mean, I deal with a lot of people who know more about all of the gold stocks than I do. And I don't know, how they spend their lives. But you also have people who frankly don't know anything about the stocks they buy.
Right.
I've had people who can't even tell me when I see a name on a list, they show me, I said, interesting choice. Is that in production yet? Oh, I don't know. It's gold, isn't it? Or is it silver? Oh, I don't know. Well, if you don't even know if it's gold or silver and don't even know if it's in production, you have no business owning it.
I've told people for decades that just because there's a company that has gold mining in its name, it doesn't mean you have any connection to the gold price.
Absolutely.
95% of them will never mine an ounce of anything.
Correct.
Yeah.
So, to sort of answer the question a little bit, I mean, I guess a lot of it depends on obviously how big your portfolio is. But also a lot depends on how much time and effort you want to put into this, or are you following one particular person? There's nothing wrong with that. There's nothing wrong with saying, I'm going to follow Trey and I'm going to do what he tells me. And I don't know anything about anything that I'm buying. I'm just doing what he says. Nothing wrong with that at all, as long as you actually do what he says. So when he says sell, you actually sell.
Right.
Because that's another issue I've had with people. Oh, I know, whatever. Doug Casey did say sell, but I didn't really feel like selling, so I still own it.
Yeah. We're going to save selling for our next discussion, because we both know that's the art of gold equities. And I think since we both have facial tics from the 2012-2015 period, I would bet that you tell your wife, one of my favorite analogies, that we're not going to miss, this high in gold stocks like many of us missed in 2012.
Oh,
So
give me one more bull market. I promise not to waste it.
terrific.
So the first thing I would say is diversify. Don't diversify to the point where you don't know the stocks that you own. That's the first thing. I mean, I think very much that the large royalty companies should be a foundation of a portfolio. Things like Franco and Wheaton and Royal. They've done very well recently, of course. But one might say over over the full course of a bull market, you might not expect them to be your best performing stocks.
Right.
But I always say to people, I guarantee you they will not be your worst performing stocks either. So to me, they are a foundation of a portfolio.
Do you have anything in the exploration and development space, or do you?
Yeah, no,
stay out of
definitely.
it? Mm-hmm.
No, definitely. I mean, we have large royalties as a foundation. We have few, but a handful of what I consider the best of the large mining companies. And then we have a lot of second tier producers, and then we have a lot, probably 30% of what we own across the board is in exploration and small royalties and exploration companies and development companies.
It's interesting. Do you file your holdings? Because I tried to sort of look you up on Bloomberg and I couldn't find a 13F anywhere. Or do you not? Are you not subject to those filings?
We're not subject to the 13F at the moment. We have been in the past. We will be again.
Uh-huh.
But we definitely file the 13Gs,
Right.
which for people out there is the 5% US. And then we file on CEDAR, which is 10% in Canada.
Right.
So we do file that. I mean, generally speaking, I will like to stay at 9.9 for Canada, and I'll like to stay at 4.9 in the US for a lot of reasons.
All of them good.
Yeah, but I'm not going to let that determine whether or not I buy anything. So yeah, we file on quite a few stocks.
Okay, I was just trying to get a couple names out of you in the E&P space, but I don't want to put you in the corner either.
Oh no, I'm happy to do that.
Mm-hmm.
So I'm not a geologist, all right? So I feel it's always very important for individuals in all aspects of life, right, to know thyself, know what your strengths are, but more importantly, know what your weaknesses are. I'm not a geologist. I could spend the next 6 months of my life doing nothing but studying geology, and I still will not have an edge over real geologists.
Excellent point.
Right. And so I tend to focus with the junior stocks. I will focus much more on things that I think I'm good at, which is judging people. I never invest in a junior company unless I spend time with the person. And spend time might mean going on a mining visit with the person. It might just mean going out to dinner with them half a dozen times. But spending time and getting to know the person and getting to know how that person acts in certain situations. That to me is absolutely critical. Just quickly, I'll give an example. We all know that the social license in remote areas is very important. I've been on a mining trip with someone who brought down half a dozen people from the New York head office. And I kid you not, we were in some outpost in the jungle in Peru. And the guy was wearing, it must have been a $5,000 Brioni suit and Gucci loafers. And I thought, how often does this guy actually visit the camp? And there were 6 of them. And as they came into the camp, it was actually noticeable that people, the workers, would sort of turn away and pretend to be doing things. I've been on another site visit where the guy, the CEO, as soon as he came into the camp, the cook dropped her pans and came out and hugged him, nice, and which one's going to get their permits quicker? Which one's going to have a happy workforce? I mean, the question answers itself. So anyway, where were we? Juniors, yeah. So in the junior space, because I'm not a geologist, I will tend to focus on people and I'll tend to focus on balance sheets. So I want companies that either have a good balance sheet or they have cash flow coming in, or I can see where they're going to be able to raise money in the in the future. And I want a history of companies that have raised money at opportune times, both opportune in the market and opportune stock prices, and haven't had this excessive dilution, which is the huge problem in the junior space. And so because of that, I'm not, I like companies like, say, Origin, Origin Royalties. Origin is a company that's got about $22 million in cash on the balance sheet. For a prospect generator is generating prospects for royalties. They could be in business the next 50 years and not go through $22 million. They've got cash coming in from the Ermitaño royalty that they have, First Majestic's mine down in Mexico. So that's coming in, and that'll probably last for 7 years. That's if they don't find new stuff. And then they have the very large, they have a 1% royalty on Anglo Gold Silicon Merlin discovery down in Nevada, which is the most astonishing discovery, I think, of the last 5 years. I mean, it's gone from nothing 5 years ago to 3 million ounces 2 years ago to 13 million ounces. These are Anglo's numbers, all in third, indicated in third, but still very, very dramatic growth. So I like a company like that where I'm protected with the balance sheet and the cash flow. I'm protected on the downside, but we also have significant upside, most of which is already, but we're still buying it, I should say. So I like companies like that because that's something I understand, or I think I understand, and it's something, but I know when the stock goes down, I know why it's gone down, I know whether that means I should be buying more. When you're dealing with, if you're looking at the geology, and it's a drill hole play and the price goes down, is it because of something in the drill core that I don't understand what it means, but there's people who do understand what it means and they've sold the stock.
Right.
And I don't know.
Right.
So yeah. I mean, I'm happy to give names. That's not an issue. Generally, I prefer to discuss larger companies because
sort of in the Torex Alamos realm.
Sorry?
The Torex Alamos realm.
Yeah,
sort of my sweet spot.
I mean, if someone listens to what I'm saying today, let's say, and they decide to buy something that I say I like, a year from now, if it's a junior company, 100 million market cap, 50 million market cap, anything can happen between now and then. And the person doesn't have the benefit or otherwise of my advice in the meantime. If I recommend someone buy Agnico, which is far and away, in my mind, the best of the mining companies, yeah, the stock price might go down, the gold price might go down, but you and I both know we're not going to be embarrassed by Agnico. We're not going to be embarrassed by Franco. And so those are the ones that I find it better to discuss, to an audience that's not going to be following me.
Excellent. Great advice. So I've taken too much of your time, Adrian, but I think we covered some interesting views on gold in the space. And I look forward to catching up with you in, a few months in the summer or fall, and we'll see how you're progressing.
Yeah, no, thank you. I'd love to do it. And you're going down to Boca, are you?
I am not.
Oh, you're not this year? Okay.
Nope.
Well, we'll catch up on an interview then.
Terrific. Well, thank you, Adrian. Have a great day and enjoy the weather.
Well, thank you. I will. Thank you very much.